between Bitcoin and ETH, you capture the essential entire narrative of the space, which is internet compute, the value layer of the internet, all of the big picture ETH stuff, and with the Bitcoin narrative, the store of value, the anti-debasement, the whatever, right? So you've covered both the technology investment and the money argument. Now, I know everyone fights over all this shit, but let's just simplify it. So you put the RAAs, the boomers, through this channel. The millennials can put it into their 401k, which is actually a very big deal and may change what the structure of bear markets look like, because you can put every 2 weeks your paycheck into this. Interesting. And then what that creates is the whole ongoing risk curve. You don't need Solana or Avalanche to be tokenized. To be ETF, created an ETF. It doesn't make a difference. It doesn't need the direct flows to win. The narrative needs the direct flows to win, and it comes through out the risk curve the other side. So I just don't think everything needs an ETF.
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day.
The entire thesis is this market is going from 2.7 trillion to, call it 12 trillion this cycle, to 100 trillion by maybe the end of the 3032 cycle.
Wow.
Okay. That's just that log adoption curve that I showed you with the internet. It backs out, same numbers. Same numbers if you back out the logarithmic regression channel of Bitcoin, right? You get to these numbers. So this is, I think, in front of us, the largest, fastest accumulation of wealth in all human history. I know it sounds bananas now, but when you double, we double a 2.7 trillion market cap, 5, whatever. But once you double a 12 trillion at the peak of the cycle, it's 25 trillion. Double it again. Okay, these numbers start getting la-la land. That's exponentials for you. So you need to capture the two parts of this equation, which is the network layer, which is where that value really gets accrued, and the applications layer. The applications layer is twofold. One is some of it's tokenized, and other is the equity layer. You guys have a VC firm, so you are capturing a lot of the applications layer. And all I'm trying to do here is capture that. This is why it's so important. The whole "don't fuck this up." It's like, just
it's not hard.
Don't lose this.
It's not complicated, right? It's
but
difficult.
But it won't be ETH and Bitcoin that accrues. They get to a certain level, but it's the whole tail of the space being worth more as you start building use cases and whatever. That's where the real game gets played in the end. The real anchoring is here. And that's why an index will do very well over time. And we've seen that from the NASDAQ. New technology comes in, ends up becoming Microsoft at the top of the pile. And it starts moving the whole index. And then it concentrates. And then more money flows into the index. It flows into those. And before you know it, you've got this reflexive loop going on.
The future of the cryptocurrency market appears to hold considerable promise, marked by predictions of substantial wealth accumulation and exponential growth potential. As we navigate through the digital landscape, it becomes increasingly evident that cryptocurrencies are not merely a passing trend, but rather a transformative force reshaping our financial ecosystems. Analysts and experts alike foresee a trajectory where the cryptocurrency market evolves into a lucrative domain, attracting investments and capital at an unprecedented scale. The allure of decentralized finance, coupled with the innovative blockchain technology underpinning cryptocurrencies, lays the groundwork for a financial landscape characterized by transparency, security, and accessibility. One of the pivotal driving forces behind this anticipated growth is the widening acceptance of cryptocurrencies as viable assets by both institutional and retail investors. Moreover, the global shift towards a digital-first economy, accelerated by recent events, serves to bolster the relevance and utility of cryptocurrencies. However, amidst the optimism surrounding the cryptocurrency market, it's essential to acknowledge the inherent volatility and regulatory uncertainties that accompany this nascent industry. Market fluctuations, driven by factors ranging from technological advancements to regulatory interventions, underscore the need for prudent risk management and strategic foresight.
Cycles are a function of the space. Everybody is so scarred. If you're in this for the long run, accept them. Don't even care about them. I didn't do a damn thing over the last down cycle because I've been through one before. So I skipped one. I've done 2 out of the 3. So I've earned my stripes. But I did what I didn't do the first one, I did properly this time, which was I bought as much as I could, given whatever cash flow I could get in the depths of the bear market. And I bought 2 things. One was Ethereum and one was Solana. And I did exactly that, and it compounded my returns. So before anywhere near the markets were through all-time highs, I was through all-time highs. I did the right thing. And people think they can be clever and cute. They think, oh, I'm going to time this thing. We've already talked about how difficult crypto fall is. Do you have a spike? Does it finish early? You don't know. The easier game is to say, I don't care. I'm just going to continue buying it. But then there's another thing is like, some people, they're particularly in the first cycle or even the second cycle, it starts to really matter. Like, I can do with this cash. I want to buy a house. I want to do that. If you're lucky enough, you could sell half your portfolio, completely secure lifestyle gains and whatever that means to you. And then you just run the rest and enjoy the bear market for the ridiculousness that it is. All of the drama, who's going to go bust, whose leverage got caught out, all of that. Just go with it. Doesn't matter. As long as you're self-custodying your tokens, and really none of it touches you. You just kind of laugh at it and then try and add to it.
In the realm of investment, adopting a strategic approach is paramount, particularly during periods of market turbulence. This strategic mindset hinges on the recognition that downturns present unique opportunities for maximizing returns. In essence, the adage "buy low, sell high" encapsulates this principle, urging investors to capitalize on undervalued assets when markets are in decline. However, such a strategy is not without its complexities, especially in the volatile landscape of cryptocurrency. Cryptocurrency markets, in particular, pose a significant challenge to the conventional wisdom of timing the market. The extreme fluctuations and unpredictability inherent in this asset class make it exceedingly difficult to accurately gauge the optimal moment to buy or sell. Consequently, attempting to time the market in the realm of cryptocurrencies is akin to navigating treacherous waters without a compass, fraught with risk and uncertainty. In light of these challenges, a prudent approach to investment is one that prioritizes balance and diversification. Rather than succumbing to the allure of short-term gains or attempting to outsmart the market, investors are wise to adopt a more measured strategy. This entails constructing a portfolio that is resilient in the face of market fluctuations, thereby safeguarding one's financial security while also allowing for the enjoyment of life's pleasures. By embracing a balanced approach to portfolio management, investors can mitigate risk and enhance their prospects for long-term success. This involves diversifying across asset classes, geographies, and sectors, thereby spreading risk and minimizing exposure to any single market downturn. Moreover, maintaining a long-term perspective and resisting the urge to react impulsively to short-term market fluctuations is key to achieving financial peace of mind.